Welcome to another episode of Trading WTF. Today is April 1st. Happy April Fools, everybody. Today on our live stream, we have special guests Priyesh Mehta and Dave Floyd. Little introduction. Priyesh Mehta. Priyesh is a graduate of Cass Business School in the UK with a degree in actuarial science. Actuarial science is applied to mathematical and statistical techniques to assess risk in insurance, finance, and other sectors. Since graduating, Priyesh has been working as a full-time trader. Currently, he works as a research analyst at the Bovell Global Macro Fund, which returned just over 70% in 2020 with a drawdown below 5%. Impressive. Priyesh takes a global macro approach to the markets and focuses mainly on FX and major equity indices. He runs a training program for the fund and trades his own personal accounts too. Dave Floyd. Dave is the founder of Aspen Trading Group, which he launched in 2002, and is the head of research for the company. Aspen Trading is a trading research company offering market forecasts, trade alerts, and managed accounts. His outlooks have been featured on Real Vision, CNBC, Bloomberg, and TD Ameritrade Network. Dave has a Bachelor's of Science in Economics, or BS, Bachelor of Science in Economics from Northeastern University in Boston. His career began in 1993 when joining the fixed income and FX desk at Standard Chartered Bank. In 2015, Aspen Trading was ranked in the top 10 currency managers by Barclay Hedge, an industry benchmarking service. Well, welcome today, everyone. In this episode, we're going to discuss how to construct an all-weather portfolio and techniques to manage a range of situations and events. Dave, is there anything you want to add to your profile?
No, not really. I mean, that pretty much covered it. I did get my MBA over in the UK back in 2011. That was a great experience. Good way to network and kind of jump back into the educational realm. After being away from it for about 15 or so years. So that was a great experience. So I do miss going to the UK, but given the COVID, not a whole lot you can do about that.
There you go. And Priyesh, anything you want to add?
Just a couple of things. So as you already mentioned, I work as a research analyst at the Bovell Global Macro Fund. Had a pretty good performance last year, returning over 70%, which is after commissions, and a pretty low drawdown. And of course, because it's a fund, that performance is fully verified and audited. So if anyone does want to check out the fund or our training program, then just visit the Bovell Global Macro site. And in terms of my approach to the markets, as you said, it's more of a global macro approach. So I focus a lot on the fundamental side of things, but at the same time, I'm not someone who dismisses the technicals. I will still look at the technicals. It just depends on what the scenario really is. And lastly, even though most of what I trade is FX and major equity indices, over the past year, I have been working more on trying to look at other instruments, trading commodities, looking at derivatives, options, futures, things like that as well. So, yeah, that's pretty much it. But I think you've covered most of it.
Well, yeah, speaking, as we were getting ready to jump on the call over here, we were talking about the performance with the drawdown. How did you achieve that? Because keeping 70% performance with a 5% drawdown, that's super impressive.
Yeah, so that was the performance for the fund, and I had a very similar performance on my personal account. But obviously, last year was a very unique year, not only in the markets but around the world, and we had a lot of volatility. I think one of the key things in achieving that return was we'd forecasted about a week before the market crash started in the last week of February that we were going to see downside and a bear market kicking in, because I think the initial expectation was when we heard about COVID is that the countries like UK, the Eurozone, the US, they're not going to be able to do lockdowns like they've done in China because of it would sort of be a conflict with human rights laws. And then I think we saw Italy was one of the first to impose those restrictions, and all of a sudden, that's when I guess shit got a little real for everyone, and then saw the volatility kicking into the market. So I think that was a major factor, predicting that in time. And then I think from that last week of February until around the first week of April, almost every weekend, I was shorting risk assets into the weekend. And that worked out pretty well because I think, except for maybe 2 weekends, we were gapping lower every time we opened back on Monday. So that was a very quick 2-3% added to the account. And then in terms of catching the rest of the crash, it was all based on, as soon as you heard headlines about more restrictions or anything like that, just getting short on the equity indices, getting short on Aussie yen, getting short on crude oil, and you just got to sit in front of the screens and sort of ride it out until you think the move is exhausted.
Yeah, that's interesting. So I guess you're just like capitalizing on the fate of the world.
Yeah, I guess that's one way to put it. But yeah, as traders, that's what we've got to do. Our job is to make money, so unfortunately that sometimes comes at others' expenses, but you have to do that.
Yeah, and what does the world look like to you today?
Well, it's obviously a lot better than it was a year ago. There's more information on COVID, and markets aren't as volatile, but I think there are still a lot of headwinds and risks that we have to take into consideration. At the moment, the focus is all on the vaccination programs and getting back to normal. But I think if you look around the world, apart from a few countries, the handling of COVID, you can probably say, has been a collective fuck up. So there's still a lot that could go wrong in the next few months. With all these countries trying to reopen, you never know, you might get another mutation of the virus and it becomes resistant to the vaccine, in which case you're going back almost to square one. So yeah, I think there's still a lot of risks, but at the moment, the markets are a lot more stable and we are on the path to recovery. So that's the main driving factor behind most of the positions I have nowadays.
Who's recovering faster than others?
So I guess the US is probably at the top of the list. China have done quite well. The UK one I find quite ironic as well, because this is really one of the first tests of, is Brexit a good decision or not? And I mean, in this instance, it's looking like a pretty good idea, given that the UK vaccination program is better than the Eurozone. So yeah, I think those areas are doing okay. The slowest is probably the Eurozone. And you've got some slow vaccination programs in Australia and New Zealand, although it doesn't matter as much for them in the short term.
What are you seeing the world look like, Dave? Macro or technical?
Well, I probably don't have the same level of granularity that Priyesh does on the macro level. I tend to be more of a swing trader. I'll day trade on occasion, maybe in some of the futures markets like the S&Ps. I'm primarily a technical trader, but it doesn't mean you don't want to be aware of what the macro backdrop is. I think that's really important. I think if you get too pigeonholed into, fundamentals only or technicals only, I think you maybe do yourself a slight disservice. I think combining the two is a pretty robust approach. It works for me. Maybe it doesn't work for everybody, but I think the fundamental backdrop can be very constructive. Especially, you just need to look at something like the S&P 500. If you're a fundamental guy, there's probably a lot of reasons you could look at it and say, I don't really think this market's fairly valued. I think we should be trading lower. But if you look at the charts, there's really no reason to get in the way of the upward move, or vice versa. Sometimes you'll look at things technically and say, momentum's starting to slow here, but then you look at what's happening on a macro front, and PMIs and employment numbers, everything looks really good. So I like to look at both of them. And I think I would agree with Priyesh. I think there's some challenges ahead. This kind of reemergence of, let's say, another phase of COVID infections is a little bit troubling. For you said, Michael, before the call, that Canada's going back on lockdown. France just went on lockdown. Really, really hard to understand when you've got all these vaccines being rolled out. So I think you have to be cognizant of that. I mean, there could be a little bit of a landmine, so to speak, for equity investors out there, like we maybe had last February and March. But as of right now, things look pretty good, and I think buying the pullbacks in the S&Ps seems to be a pretty solid bet. I'm also thinking that 10-year notes are probably in an area where they look pretty cheap. They just wrapped up their worst quarter since, I think, 1983. So really, really bad quarter for notes. But I think probably in the weeks and months ahead, I think that 10-year notes probably be a lot higher. I think you'll get yields maybe back below 1.5%. Right now we're at 1.68. Maybe we'll even get down to 1.25. But that might only happen if the economy begins to slow down. If we get down there, but as of right now, the economy seems pretty strong, and that'll take some monitoring going ahead.
Yeah, well, people want to get back to normal, so I think that's going to be a big factor for the economies, and I think people forget how quickly society can actually recover and get and over time. How long did it take to rebuild after the war? So that's when the booms happen. Yep. But every situation is different. Since we have both a macro and technical approach over here, I kind of want to dig in a little bit further on that. Maybe go a little off script if that's okay, and I guess hear both of your inputs on pros and cons of macro versus technical, and from both sides. So pass that over to you, Dave. What's good about technical, macro, pros, cons,
well,
things to watch out for.
To be honest, I think you can make pros and cons, and I think they're similar for both camps. I think trying to be as objective as you can in your analysis is really key. And you might say, well, price action, that's pretty objective. Well, it is, but we have a tendency to be subjective about it. I think a good phrase that I think is really important to understand or to keep in mind is observe, not perceive. And that's especially true in terms of technicals. We always have a tendency, or I shouldn't say we, traders have a tendency to look at it and say, well, I think this will happen based on this, and that might be helpful on some level, but sometimes just kind of going along for the ride is the better thing. You're observing what's happening, and you're drawing a conclusion based on what you see happening, based on what you think might happen. And I think we can get ourselves into a lot of trouble when we do that. I think you could probably make the same argument on the fundamental side. Whether you're analyzing a balance sheet, there's a degree of subjectivity to that. There's an art to reading a balance sheet versus just the hard P&L numbers. Same thing with macro, in terms of, economic data. Same thing, the numbers are pretty clear, but maybe we have a tendency to extrapolate going forward as opposed to looking at it and observing simply what is there. So I think as human beings, we err on using both of those when we get a little bit too much of an opinion or too much of a perception of what might happen, versus actually just looking at what the data is saying and saying this is what's happening and going with that. And that's a hard place to go or to be, not 100% of the time.
Yeah. You mentioned something like, you get a perception in your mind and you think, well, this is supposed to happen and it's not happening. And I guess I think that's one of the most frustrating parts when you're trading is you're like, well, you have a thesis and everything is going as according to your thesis. And then all of a sudden the markets aren't moving the way your thesis is telling you to do it. And I guess, how do you control that? It's a little frustrating.
Let me just add one more little addendum to that overall commentary. Is that's where a lot of people get hung up. They think that trading is a game of black and white where A plus B equals C. And it's not like that at all. Trading is probably more of an art than it is a science. And, you have to have that degree of an opinion or a forecast. Like Priyesh was saying, we forecast last February that we were heading into a bearish situation. That's a forecast. It's not an observation. That's a perception. That's a forecast. And that kind of is at odds with what I just said, but it's also not at odds. It's how do you strike that balance between a very solid observation and an observation with a healthy dose of a forecast. You got to meld the two together. And the reason I bring this up is that there's this notion out there, especially in the midst of a bull market that we're in right now, that trading's like just so simple. You buy every pullback, or you follow my 3 simple steps. And I think it's really disingenuous. And the fact that Priyesh has audited performance numbers, the fact that we have audited performance numbers, is how you distinguish yourself in this marketplace. Everybody out there is claiming they know how to trade, and maybe a lot of them do know how to trade. But unless you're actually showing hard data that says, yeah, in this market environment, I was able to generate X, and I'm still continuing to generate X, words just kind of fall flat, because I know how difficult it is to trade. It's a very challenging profession. And it's your experience in the end that really kind of separates you, and your process. You have to have a very, very strict process in place. People that jump around all the time, I don't know how they do it. Some people can, but most people can't. You've got to have a process in place. So I'll just leave it at that. And I'm sure Priyesh has plenty to add to this. Maybe we agree, maybe we disagree, and that's okay.
Disagreements are always fun.
Yeah.
What would you say about macro versus technical, some of the holdups and stuff like that, Priyesh?
So for me, my main focus is it's a macro approach to the market. So my analysis is generally more skewed to the fundamental side, but I agree with what Dave said there about, the fundamentals, the data and things like that, that's facts, but how you interpret that, that's an art. So that's going to be subjective. And in terms of your trading, I think it's very important to find a balance between having a somewhat mechanical approach, but also having a bit of a dynamic approach. And I think the macros allow you to maybe add a bit more, at least from my perspective, they allow you to add a bit more flexibility to that approach. Whereas the technicals, I find them pretty useful for, looking at your entries, your stop losses, your exits. And technicals, I feel, is something that is gaining a lot more traction nowadays. And it works most effectively when you've got more people looking at those same levels and reacting to them. And since that's happening a lot more, I think it is important for everyone to pay some attention to the technicals, especially in this environment. From a macro perspective, the main theme is the economic recovery and the vaccination programs and things like that, which is going to play out over 1 or 2 years. It's not going to happen in a matter of weeks. So the thing you're generally looking at is a recovery. You're looking at going long on risk, a recovery in the stock market. But to position yourself and get into those trades, you're not going to really have any short-term fundamental catalysts. So you're better off looking at some of those technical levels and using them as a gauge of where you should get in, where you should get out, and how you should position yourself.
Well, I always like to think, a good technical setup aligns with a fabulous fundamental announcement, and they kind of just go hand in hand. You're like, oh yeah, that was coming, but it needs a fundamental announcement to push that technical where it's supposed to go. What I'm seeing right now in the markets is a lot of traders are betting against the USD, and the USD just keeps getting stronger and stronger and stronger. And everyone's saying, well, they're injecting so much money into the markets, why isn't it going down? And I guess there's different ways to look at the matter. So that would be like people are following a fundamental thesis, but the markets just aren't doing what they're supposed to do. I don't know if I'm throwing you guys on the spot over here, but any comments on what's going on over there as the US keeps strengthening?
Well, I think sometimes, throwing, like you said, the argument is being made that the Fed and the government's throwing so much money at it that's diluting or should devalue the dollar. Not really sure. There's probably a lot of empirical evidence that would support that. There's so many other things that can drive what the value of the dollar is. Of course, there's the technicals, and I'm sure Priyesh can speak more to the macro. I think you have to be a little bit more diligent about any analysis you do. And, kind of like I look at making a comment like that's kind of like a comment you make at a cocktail party. I don't know how rooted in fact that particular comment is, but I know that I have a really good friend of mine over at Nautilus Capital, where they do a lot of quantitative analysis, where they'll do a lot of look back periods and say, well, when these factors were happening, this is what the impact on X was, or let's say in this case, the dollar. There's a lot of other data sets that we can all be looking at that are going to provide that objective framework. I think making a very simple, cause effect, like, well, a lot of more stimulus equals a weaker dollar. Well, that may be the case, but that may not be the case. I think you've always got to look at this stuff in the context of what it's done historically and make that leap, make that assumption. I hate to say it, but it's true. There's that art form that Priyesh was talking about. You can say, okay, well, this is what's happened historically. This is probably what's going to happen again, because we've got that same recipe of things coming together. So, I think you have to be a little bit more diligent about how, and I'm not saying you, Michael, but I'm just saying traders in general have to be a little bit more diligent about how they're arriving at their thesis.
Yeah, totally. And I guess let's just, have some fun with this. What would you call the Wall Street Bets Reddit forum? Was that technical or macro trading?
I would say special situation.
Priyesh?
And I think that's apt. Yeah.
Well, I guess a lot of it was driven by looking at what was a short interest on various different instruments, and I don't think that really fits necessarily into a macro or a technical category.
Yeah, I call that pin the tail on the
gamma
donkey.
Squeeze.
Pin the tail on the donkey, yeah.
It's a gamma squeeze. It's amazing how they pulled it off.
Well, you get lucky once. I don't know if you're going to get lucky twice.
I'm not sure it's a repeatable approach. I mean, it makes sense, that thing's heavily shorted. Let's buy a boatload of call options, force the dealers to hedge, and voila, we've got a higher equity price. Makes sense. Yeah. I'm glad they did it. I mean, it highlighted something everybody should be aware of.
There you go. All right. So on average, how long would you say that you keep your positions open for? Let's start with Dave.
On average, my positions are several hours to a few days, maybe a week or two at the fringe. But I fall into that swing trading camp for sure.
And the market goes up, it goes down. You're essentially just looking to place your entry at a top or a bottom and then go for a little bump up or down.
Yeah, and I think one of the things that people should factor in is that you got to play to what your comfort level is, what your risk tolerance, your personality. That's where I'm happy. I'm not happy trying to make a big macro bet. It's not that I'm not happy. It's just that's not where my comfort level is. I like to kind of get some sort of an immediate verification that I'm correct, and then ride it up for a bit. That just suits my personality. That doesn't mean it's right for everybody else, and that's kind of where my sweet spot is.
And I'll throw the same question over to Priyesh. How long do your positions normally last for? What do they look like?
So for me, the time horizon is quite a fluid thing. At the moment, as I said, from a macro perspective, you're focused on the economic recovery. So that's something that plays out over the next couple of years. So at the moment, the average holding time is around 3-4 months on my positions. I've had positions which have been open for the last 8-9 months, some which have just been a few weeks. But at the same time, if we go to last year or even 2019, this time last year when you had all of that panic in the markets, I was getting in and out of trades pretty quickly, just holding for maybe a few hours each day. Before that, you had a lot of Trump headlines and Brexit headlines in 2019. So again, you jump in on the headline and you let the move play out over maybe about an hour or 2 hours, and then get out of the trade. So, for me, I would say that the underlying macro trigger for the trade is going to determine how long I hold it.
And what kind of risk are you able to, or drawdowns do you stomach per trade?
So the way I trade is I try to scale into my positions, so I don't jump into an entire position in one go. And the way I'll do that is the way I'll determine my trade size is based on the average daily range of the instrument I'm trading. So I'll calculate it to be something like one average daily range is risking about 0.5%, and that keeps things consistent. And then with the shorter term trades, you'll have a bit of a tighter stop, so you might only be risking around 1 or 2 average daily ranges with your stop loss, whereas a longer term position, you might be looking at something like 5 or 6 average daily ranges.
So if a daily range is this big, you're thinking, okay, it could go this much or this much, and you kind of factor that in.
Yeah.
Okay. How about for you, Dave? What is the risk?
I keep it pretty basic. I'll risk anywhere from 1% to 2% of my entire portfolio, so to speak. So, maybe I've got my FX account over here with X amount of dollars in it, but my portfolio's, let's just use round numbers. Say portfolio's $1 million. I've got $100,000 in my FX account. I'm going to be risking anywhere from 1% to 2% of my portfolio value, and using the margin and leverage afforded in an FX account to trade, pretty decent size in there. But I think the thing that a lot of traders run into is they start sizing their trades based on what their trading account value is versus their whole picture. And when they have winning trades, you're not really moving the needle on your whole portfolio. So I think it's really important to use your portfolio. And for me personally, I don't want to risk any more than 2% on a per trade basis. And that's not 2% of, I'm not allocating 2% of my capital. It means that if I get stopped out, I've lost 2% of my portfolio. And I think that's a pretty reasonable number, because inevitably you're going to have, a string of losers in a row, 3, 4, 5. It happens. I mean, nobody's perfect, of course. And, you start getting north of a 10% drawdown. If you have 5 losing trades in a row, that's a tough one to come back from. So think about it in the other context. If you're not really thinking about risk and you're unknowingly risking, let's say 4 or 5% per trade, and you hit that 4 or 5 losing trades in a row, well, now you've got yourself a really nasty hole to dig out of. And from a mathematical standpoint, just to get back to break even, you're probably looking at returns of, anywhere from 30 to 40% just to get break even. Not only to mention that you're beaten down mentally, it just took a massive drawdown. So this is a marathon. This is not you only live once, which is the common acronym that's being thrown around. I want to be around next year. I've been around since 1995. I want to be around in 2025 and in 2030. So you've got to manage that risk. Live to trade another day.
Yeah, well, you each mentioned something really important. Live to fight another day, for sure. And you got to scale into positions, because there really is no perfect entry. I think a good entry is being able to scale your entry throughout the ups and the downs, so that way you're not putting everything at one level. You understand the market goes up and it goes down. And if you think you're going to put a trade in and it's going to go your way right away, I think you're mistaken in that. So you got to be able to scale.
That might happen one time out of 10. But not everybody's looking at the levels you're looking at. So don't be surprised when you get into a trade if the market goes the other way, which, again, as you said, scaling in. For me, I have a zone. I'm thinking, I think prices are going to basically stall right in here, and I'll start to nibble. I'll give you a good example. I'm looking to get long New Zealand dollar. Not yet, but when I start doing it, I'm going to nibble at it, because it's been in a pretty good downtrend for the last couple of weeks. And I'm not in the business of trying to call bottoms or tops. That's a really, really tough game. But I'll start to scale in once it looks like prices are bottoming. Doesn't mean they are. But if I go all in the midst of a downtrend and I'm wrong, that seems to me like a really silly way to do it, because you're going completely against the trend.
Yeah. So, Dave, you focus primarily on trading G8 currencies for stability. How's the volatility looking, and within across the ranges, and how important is volatility for trading?
Oh my God, volatility is everything. The more, the better. For me, I love it. That's where I've had my best years, is in years where there's exceptional volatility. And I think any trader who's been around would echo those sentiments. I keep it pretty basic. I trade euro sterling, Aussie dollar, Kiwi dollar, CAD yen, dollar Swiss, and that's about it in the FX space. I keep a very narrow focus. And the only other two markets I really look at and trade quite a bit are 10-year notes and S&P futures. And that's plenty to keep an eye on. I don't think there's really much more I could possibly keep an eye on and expect to remain effective or have any degree of an edge.
Well, how many more screens could you fit over there? That's the question.
I've got three.
I'm looking behind you.
I've got three, and that's more than enough.
Oh, you got a wall over there, another like 4 or 5 feet to the ceiling. You can probably stack them up if you needed to.
Yeah, no, I don't need quite that. Like, I've got a pretty simple setup, believe it or not. And I think, again, less is more. Again, my definition for me of being successful is really being intimate with what you're trading, watching the price action. Doesn't mean staring at the screens all day, but kind of getting in sync with what's happening, as opposed to jumping around looking for opportunities. Let the opportunities unfold as you watch them. And that, to me, is where I have an edge, I think. And that's what works for me.
There you go. Keep that edge sharp. Priyesh, as we're streaming on TradingView, we have forex, stocks, futures, crypto traders, all of the above with us. Can you summarize the difference between trading and investing?
Yeah, sure. So I guess there's probably a few differences, maybe 3 or 4, but I guess the main one is really the time horizon and the holding period of your positions. Now, I think this is a bit of a debatable one. When does a trade turn into an investment? For me, I generally see that as about 6 months, because the way I manage a trade that I intend to hold over 6 months is different to how I manage a trade which I plan to hold for maybe just 3 or 4 months, or even shorter. So I think that's really going to be the key difference. Then, as I said, trade management is another one. So I scale in and out of my positions. Now, you can do that whether you're trading or investing, but I guess when you're trading, time isn't always on your side. So even if you're scaling in, you have to be a little quicker about getting into your entries. Whereas with investments, those entries are probably going to be a lot more spaced out, and you're going to take much longer to actually get into whatever your desired full exposure is. The third one, which I personally found with investing, is if I'm investing, I don't need to be monitoring those instruments like a hawk every single day. So that's actually allowed me to trade more instruments when I'm investing. So I can look at things like individual stocks, the equity indices, look at some of the commodities. And I guess that's one of the benefits with investing. You can actually assess those different instruments, and it doesn't necessarily mean you're doing any more work, because the underlying ideas are still based on a macro theme, but it's just that you might have a better instrument available to execute a certain trade idea, rather than what I do on a short-term basis, which is typically FX and the equity indices. And the fourth difference, I guess, again, this is from personal experience, I pay more attention to the technicals, put more weighting on the technicals with investments, because your underlying fundamental idea is something that plays out over a longer period of time. So rather than just jumping in randomly into a trade, it's a lot better to use the technicals to try and, obviously you're not going to get it perfect, but to try and time your entries and limit how much drawdown you might have to sit through before the trade is playing out. So I think those are the 3 or 4 main differences for me between trading and investing.
The technicals normally give you essentially a history of how the instrument or asset has performed. It kind of, it gives you some stability to understand, tops, bottoms, where the supports have been, where it can go next, and technicals normally obey the rules of making new highs, coming back, testing the lows, and then ranging around a bit, and then going back up, and then the fundamental view over the long term will help you reach that. You mentioned that you trade your short-term trades versus your investment trades a little bit different. Can you explain a little bit more about that, like what that looks like in terms of how you would field those?
Yeah, so short-term trades, like Dave said, it's hard to focus on too many things. So trading-wise, I'll focus on mostly just FX and the major equity indices. I'll generally have a set amount of exposure I want to get into with those positions. So it might take about 3 entries to get to that exposure, but once I get there, I'll leave it there. Whereas what I typically do with investments, if it plays out in the ideal way, is as the trade is playing out, I'll be moving my stop losses to break even and adding more entries. So that allows me to increase my exposure quite substantially without really increasing the risk too much. And therefore, you've got a higher profit potential there. Whereas with trades, you don't necessarily have that much time to build so much exposure, and the entries are going to be a lot more clustered together. So you're probably taking on a lot more risk there if you get any sort of significant gaps in the market. So that's where I guess there's also a difference in risk management between the two.
Dave, lots of investment personalities are always saying diversify, diversify, diversify. What are your thoughts on that as a trader, as an analyst, about diversifying? Should traders diversify, and how do they do that, if so?
Well, I guess it depends on what type of a trader you are. If you're a day trader or a swing trader, I'm not really sure how diversifying really helps, because all you're trying to do in that moment is capitalize on shorter term trading opportunities. You're trying to generate alpha in the purest sense. Having a whole list of trades open on a short-term time frame, I'm not quite sure is really diversification, and I'm not really sure how that would help you. I do think, obviously, from your investing perspective, obviously diversification can be important. What I've learned over the years, and kind of how I structure my stuff, I've got my trading accounts, which are basically 2, an FX account and then a futures account. And then I've got my investment accounts, like my retirement and whatnot. And for the most part, I just index those. I don't have the bandwidth and, quite frankly, the interest in trying to find individual stocks that allow for the diversification. I think the data is pretty clear that an indexed portfolio makes a lot of sense. I might, adjust the exposure I have periodically, meaning that I may not be 100% invested in my accounts. But by and large, I try to keep it simple. Just invest in the index, take the guessing out of it. But that's really more of a function that I'm just not curious enough or have the bandwidth to, be a stock picker on the side as well. I've got enough to do on the trading side.
Yeah, I like what you say. You can diversify your long-term investments, but when you're trading, it's really just you're going to be fighting multiple battles on different fronts. And
yeah, you got to be a sharpshooter.
Yeah,
you got to be a sharpshooter. And there's a great interview. God, I can't remember the guy's name, but he's in London. He's in the most recent Market Wizards book, The Unknown Market Wizards, and they called him the unicorn trader. And he's definitely more of a short-term trader, and he just waits for those setups that are the best and goes in large, as opposed to trying to take a lot of marginal setups. He waits and he waits and he waits, and he throws all his chips on the table. Sometimes it works, sometimes it doesn't. And I think that's really the definition of what you need to do as a shorter term trader, is wait for those perfect setups, use the leverage afforded to you, go for the throat, and then get the heck out of the trade and wait for the next setup.
Yeah, that's ballsy though. You gotta throwing all your chips on the table, not scaling in. That's I guess it works, but
well,
you gotta be lucky. There's no
yeah,
lucky.
I mean, I'm not saying you just go hog wild and you risk you mortgage your whole future, but the way he described it, I'm not saying I do it this way, but I at least put in a size position that I'm comfortable with. But at the same time, you're like, wow, okay, I'm putting a lot of money on the line here. That just fits his personality. He's putting it all. He's putting a significant amount of money on the line, and knowing his methodology, he knows that his stops are very tight, and he might lose. But if he wins, he's going to win at many multiples of what he risks, and he's willing to do that maybe 3 or 4 times a month. And that's how he plays the game. Again, that may not work for everybody, but I like his thinking. Very narrowly focused, waiting for exactly what he's waiting for.
Yeah. And Priyesh, many forex traders use either scalping, swing trading, or day trading strategies to reallocate capital. As a long-term position trader, how does your risk management strategy differ?
Okay, so I think one of the similar things is probably that you want to most of the time have a stop loss, whether you're trading or investing. But one of the differences there, which last week was actually a good example with the Turkish lira gapping on Monday. And that actually made me rethink, is it worth actually holding a stop loss over the weekend? Because it doesn't really serve a purpose unless you're with one of these brokers which offers you a guaranteed stop loss, then it's a different thing. But over the weekend, the stop loss isn't really offering you much of a purpose, because if you do have a gap like that, you're just going to get stopped out immediately. And the better option is probably, if you're able to with your broker, then hedge your position instead and then manage it once the markets open up again. So I think that's whether you're investing or maybe holding medium-term positions over the weekend, that's maybe something to consider on the risk management side. Also, another difference is with investing, you probably take longer to build up your positions. As I was saying, like the ideal way is you get into your first entry, that starts to move into profit, you move the stop loss to break even, add more entries, and you just sort of repeat that process and keep increasing your exposure without really increasing your risk, which I think because of the luxury of time you have with investing, you've got a better chance of doing that there rather than with a trade. The other thing I think that's important to consider, you were talking about diversification, and I think with investing, the way I sort of treat my positions are like mini portfolios. So, like for example, one of the mini portfolios I've had running for a few months is a bunch of airline stocks, because they've really struggled to recover from the crash last year. But as things open up, they should start to pick up as well. And at the same time, I've got exposure in your major equity indices. So those two are going to be, to an extent, positively correlated. So then you've got to just consider how much exposure do you really have, even though the ideas to get into the trades might be slightly different. You've got to look at that correlation and just consider how much exposure you've got. So I think that's where diversification maybe becomes a little bit more of a factor. And then the last difference I would say with investing and trading and the way you manage risk is, so trading, you probably just use a stop loss, whereas with investing, I have at times used things like options contracts instead sometimes to manage the risk. I might still have a stop loss on the position, but I might also buy some options to hedge or protect some of the exposure. So for me, those are really the main differences in how I manage risk on trades versus investments.
Nice. And Dave, I'm looking back, and you started working with the banks. What are some of the advantages that banks have for trading, or some tools that the individual could that they're not aware of that might help them, or is it just an uphill battle for individuals versus banks?
Well, it's been a long time since I've been in the banking sector, and at that time I was what they call a sales trader, and we made our money off the the bid ask spread. So technically, we weren't really risk taking in the classic sense. We were just filling orders. Sometimes we might have an opinion, and we might not hedge our exposure. But I think those are two very different things. If you're simply facilitating order flow, you're kind of directionally neutral. You're just trying to make sure your book is hedged, make a little money on the spread, make sure you're hedged or not. Whereas if you're a trader, you're outright speculating. Do the institutions have some edges from time to time? Yeah, of course they do. They have a better sense of what's happening in terms of flow, who's doing what and where. And that can be helpful, but I don't think that's a requirement in order to be successful. I know a lot of guys and gals who trade very successfully, and they do it independently without a whole deep team of analysts and sales traders that are on the front line at a bank or in an investment bank.
All right. And Priyesh, we kind of touched upon this in the last one, but we'll dig a little deeper. Forex is arguably an all-weather asset class. No matter what's happening in the economy, exchange rates will never stop fluctuating. Are there any macroeconomic situations that would make Forex unviable? And you touched on that with like Turkish lira, but what are some other examples?
Yeah, so I guess unviable may not be the correct word entirely, but there are times where it's maybe a little trickier to trade FX, at least from a macro perspective, and you might be better off with other asset classes. So I think a good example is the middle of last year, because from a fundamentals and a macro perspective, when you're trading FX, the main thing you're looking at is central banks and monetary policy. And any sort of development that takes place, you're always asking, well, how is this going to impact monetary policy or interest rates or QE, whatever it is? But last year around this time, we had the major central banks just cutting rates massively, introducing all of these QE measures. And after that, it was pretty clear, well, that's where monetary policy is going to stay for the next couple of years. So then a lot of that, as we know, the markets like to price these things in ahead of time. So at some point, all of that's pretty much priced in, and you're not getting too much going on from a fundamentals perspective. We did obviously then have, as the recovery kicked in, you had the Aussie dollar and Kiwi, Canadian dollar, your commodity currencies doing pretty well. But that's where I feel like unviable is maybe not the completely right word. You could have maybe gotten into those positions, but for me, getting into something like the S&P or NASDAQ was a much simpler and a much easier trade. And also with FX, you're trading currency pairs, so you've got to consider what's happening on both sides. Whereas if it's an equity index, then you're only looking at one economy, really. So again, that's something that can sometimes make it a little easier. Like last year, if you're trading FX and trying to trade the recovery, one of the main FX trades was short dollar and long commodity currencies. But how much exposure do you want short dollar? Because at some point you're probably overexposed and taking a bit too much risk, especially if you're holding those trades longer term. And that's where maybe looking at some other instruments and asset classes could be beneficial.
All right, there you go. And I guess I'll put this question out to both of you. When trading for the fund or the managed accounts, are you just thinking about P&L, or is your attention drawn to drawdown and Sharpe ratios? And I'll throw that to Dave to start.
Well, drawdowns, obviously very important, but, I always go into a trade going, with the mindset of, this is where I think prices are going. This will be the benefit. And here's where my stop loss is. And I think that's probably just simply a function of what those other measures will become after the fact anyway. So I first go to, here's what I can make on the trade. Here's what my risk is. I guess secondary to that is this is what the result of my drawdown will be, and this is the result of my Sharpe and my Sortino ratio. So I think the two kind of go hand in hand. I think more in terms of how much can I make on this trade, or how much can I make for my clients.
Throw that back to Priyesh.
So I think risk is important and looking at your drawdown is important, but if you've got a good risk management strategy in place, then it's not something you need to worry about constantly, and then you can just focus on the returns. But it is worth periodically to have a look that if you're returning X amount, how much drawdown did it take to get there? Because like you mentioned, the returns at the beginning, if I was returning 70% but with a drawdown of 20 or 25%, that's not that great. But a drawdown of below 5% is pretty good. As I said, though, if you have that risk management strategy, then drawdown isn't something you need to worry about on a daily basis, and you can just focus on the P&L and the returns. But I think the key is just having that risk management there, and then you can focus on the trades and focus on how they're doing.
Nice.
One thing I would add to that, Michael, is that the one thing I've learned over the years, and I actually read about it with one of the Market Wizards books, one of the original ones. There was a gentleman by the name of Bill Lipschitz who had headed up or started the FX desk at Salomon Brothers way back in the day. And the one thing he learned really early on, or later on in life when he started his own hedge fund, was that when you're talking to a client and you say, hey, can you handle a 10% drawdown? They're sitting over there nodding yes. Make a mental note that what they really mean is a 5% drawdown. Everybody's agreeable to what your drawdown could be because there's an ego component of money. Let's face it, especially with men. It's like, oh, sure, I can handle the 10% drawdown. My experience with clients over the years has been just the opposite. They say one thing, and then when things don't go too well, which inevitably does happen, their risk tolerance is usually half of whatever they said. So I'm very mindful of that, but at the same time, like Priyesh said, if you manage your risk well, you're going to keep yourself out of hot water, but you can't avoid drawdowns. That's part of the game. And if you can't handle drawdowns of any extent, then you probably shouldn't be participating, because you can't make any money in the long run without throwing a little money out there to risk at the same time.
If you want to win, you have to pay to play. That's what
exactly.
That's what one of my buddies says. You got to pay to play if you want to, and you got to take a chance to win.
Yep.
And you've been mentioning a bunch of books, and I just ordered a book the other day, and I just got it, The Tyranny of the Federal Reserve. And like the cool thing about it is it was like just printed on March 26th, so I feel like it was like a special edition for me. I was like, no way. I was like, they just printed just for me. It's like limited edition book or something like that. So I was like, no, I guess it's not something they keep on the shelves. I'm very interested in reading that and seeing what's behind the scenes. And I guess, sorry for the tangent. I guess leading off, heading off to the tailwind. Both of you, do you want to maybe state how people can get in touch with you and give a little pump? Start with Priyesh.
So if you want to get in touch with me, then my Twitter handle is Priyesh2201. You can also visit the Boval Global Macro website and send an email there. So those are the two easiest ways to get in touch. And I just want to say also thanks to Michael for this opportunity and chance to speak today.
Sweet. Dave.
Yeah, many thanks, Michael, and many thanks, Priyesh. Pleasure meeting you for the opportunity to have the chat today. Same thing. My Twitter handle is at AspenTrading10. My website's aspentrading.com, and what we provide is pretty simple. We provide research if you want to be a self-directed trader and basically follow along with our research and our trade alerts. Or if you're not inclined to do that, we take those same exact trades and put them into a managed account or a trade copier program for you. So we cater to the self-directed and to the ones that want us to handle it all. And that can all be found at aspentrading.com.
Sweet. And I got to do a little marketing pump, make my marketing team happy. We run a little incubator program for traders to help get them funded. You can go check that out at scandinavianmarkets.com/fundmytrades. And we've also developed a Telegram channel where the link is at the bottom, where we post daily analysis and insights. Don't be shy. Come say hi. We'll be back in 2 weeks with another episode of Trading WTF, What the F, and Where to Focus. And again, thank you so much, Priyesh. Thank you so much, Dave, for sharing your insights, your knowledge, and hopefully some helpful tips for the traders out there that are watching today. Thank you, and we'll see you all next week. Thanks for watching, everyone. Take care.
Thanks again. Bye-bye now.
Bye-bye.